Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Hey everybody, welcome to Mortgage on My Mind. I'm Natalie Salins. I am so excited to welcome our guest, Patrick Grimes, today. He's a little bit different of a guest than we normally have. He's actually an investor and he has so much to share with us about building wealth in other ways. He is the founder and CEO of Passive Investing Mastery and an Amazon best-selling author. With a career spanning engineering, business, and real estate, he has built expertise in recession-resilient investments that generate passive income and long-term financial security. Through his work, Patrick helps professionals and families create wealth beyond Wall Street by focusing on proven cash-flowing strategies in real estate and alternative assets. So thank you so much, Patrick, for being on. I'm super excited to talk with you about this because I feel like a lot of people get into real estate for the sole purpose of earning passive income. And I have properties that I own and I really don't feel like it's passive. So it's an interesting thing whenever we say earning passive income, when it really doesn't feel terribly passive having properties. Welcome. Thank you for being on today.
Natalie, excited to have the conversation. I definitely relate. I was a high-tech automation robotics engineer for years, and I was doing single family, feeling exactly what you're feeling. This was not passive. It was very active, even though I was doing it out of state. I was moonlighting it and trying to find deals, underwrite deals, and trying to get quotes out with contractors, then negotiate, then manage contractors, then refinance, and then rent, and then manage. Even the property manager was brutal. It really is hard to scale.
Yes, it's not fun. Not always fun. Out in LA, it's nice because the property appreciates well. It's much more about property appreciation than cash flow, but even still, it doesn't feel passive, so to speak.
Yeah. And you're out of LA, is that the case?
Yes. And yourself?
Well, I'm out of Honolulu right now, but when I was doing single family, I was actually in Los Angeles and Orange County at the time, and I was doing it more so in Texas because that's where you could cash flow and you had more resilience and stability from economic downturns. So that's why I went that direction.
Totally, I bet. Do you still have those properties?
I actually sold the last one last year, and it was more of a challenge selling it than I almost felt it was, because now I traded up to larger apartments, energy, medical, legal. I just found that scaling into bigger assets and partnering with others was more efficient. So I killed it. I did really well on those properties. But yeah, the time trading away so much of my nights, family, friends, and hobbies to do it all myself and get caught in that DIY trap, that was challenging.
Certainly, yeah. Well, then tell us a little bit about building wealth beyond Wall Street. I know you mentioned having medical and energy funds. What is that? What does that mean exactly?
I don't have energy funds. I do promote like energy is a great alternative that doesn't rise and fall with other markets like the real estate or stock market. But I also it's not for the faint of heart. Energy is a bit volatile, like the stock market. But even more, I think the real risk becomes when you're in any one type of asset class and you're just all in, like the stock market or crypto or even real estate. Because I lost everything in 2009 and 10 when subprime mortgage collapse happened and single family. And then I lost a lot of money in the last 3 years when we saw apartment buildings take a 10, 20, 30+% hit. And more so than the subprime mortgage collapse. Apartment buildings in the last 3 years have taken a hit.
Well,
So it's more important to be in
and
more than one industry. It's more important to be in
yeah,
investments that don't
diversity,
rise and
diversity.
fall together.
Why did apartments take a hit last year?
A number of reasons. One is post-COVID, there was delinquencies. Delinquencies meaning that they put an eviction ban in place, and then all of a sudden, for the first time, people didn't have to pay rent. They were able to just hang out. And in some markets, it was worse than others, like Atlanta, where traditionally was very landlord friendly. All of a sudden, there were some places like in Fulton County where it was, or Stockbridge, where it was like 12, 18 months where they could stop paying rent and you couldn't get them out for a year and a half. Imagine if you ran a grocery store and everybody on your block could walk into your grocery store every day, fill up a bag of groceries every day, walk out the door, and there was nothing you could do about it. It's
Yeah.
wild
Oh, I
what
know.
was
Yeah, yeah.
happening.
I
And
have a
so that,
tenant who hasn't paid since before COVID and has not paid yet
yeah,
because
yeah.
the
So, I mean, that,
moratorium went longer and I've just not been able to get out. And now we're still, she literally lived in the apartment for 6 years and not paid and hasn't
oh,
had to.
bless you.
Yeah,
I'm sorry to hear
it's
that.
crazy. No, it's okay.
Yeah.
It's okay. So I get it. I get it where you're
Um,
just like,
well, that was the trigger, right? Because it drained everybody's operating reserves, it delayed everybody's timelines. And if you were in short bridge debt, short, they call it bridge debt, or what's called hard money in residential, is bridge
mhm,
lending and commercial. And those are 2 to 3 years. So if you were trying to improve the building and get increased rents and occupy it or do renovations, you didn't get to do that during that time. You just simply, people weren't moving
right.
out, you couldn't turn over, you didn't have the capital, barely staying alive. So maybe those bridge loans are coming due. Unfortunately, liquidity strapped the debt markets. Lenders just weren't renewing. The values weren't there that they wanted. In fact, they had dropped dramatically because interest rates skyrocketed, meaning cost of money is big, so the value of apartments went down. People weren't willing to pay the same amounts. So just a
Right.
lot of those factors in, a few others. Inflation dramatically increased payroll. It increased materials, construction costs, the renovation costs, and all that hit.
Right.
So all those things just made a perfect storm and caused what was like a generational wealth building preservation tool. It caused some major catastrophic losses still being seen today. There's still $1 trillion in distressed commercial real estate debt. And the office obviously is disproportionately bad, and that's a completely different animal. But apartment buildings are among those.
I know how bad it's been for commercial, of course, because everybody's dropping. Even movement mortgage, we've dropped two of our like on the ground spaces because it's just not necessary. We have all figured out ways of being in our own office in our own space without
Mhm.
needing to pay a bunch of money to sit in a commercial space. I think it's a give and take. I think we lose a lot from not being around each other on a daily basis, but of course it's much more expensive. We get better rates if I'm not spending 10 grand a month on an office space. Like it's an interesting give and take for sure.
Agreed.
So then that's why you got into, like we were saying, diversifying your investments. And what does that look like?
It's tough because people think diversification are like, yeah, my 401k's got 20 different index, mutual, whatever funds, and
Bonds and
their
yeah.
financial planner is saying, oh, let's get you into REIT because that's I've got articles in Forbes and I got a bunch of books and one of them is called The Ruse of REITs. And so because it's still sentiment driven paper, I don't like
Can
using the
you
word.
can you tell the audience really quickly what a REIT is? I think we might have discussed it once or something, but what is a REIT? I know it's for everybody out there. It's a real estate investment trust, but what is it?
It's a way that you could raise capital and start buying assets and then essentially sell paper, not actually sell interest directly in the underlying real estate, but you sell paper. And then that's why larger REITs, and that you don't get the depreciation. You get maybe a small tax advantage, but it's not the same tax advantage. It's not the same inflation hedging. You don't have the real asset protection because there's a middleman. The middleman
Mhm.
selling paper that's only as good as the company that owns the REIT, not the underlying real estate. And so that's why it's actually trend with the stock market as opposed to with the real estate market. And REITs are something that people think are a diversification because it's available on with their financial planner. And what that means is the financial planner will take a percentage of their investment. So they won't give them like opportunities to invest in real property. We give them opportunities to invest in paper property. So
Yeah.
in simple terms, I don't want to go too deep, but real diversification, I don't even like using the word diversification because people think they're in a lot of kinds of real estate and they're quote diversified. But the fundamentals of real estate are interest rates, right? They're whether or not the people can pay for rent. So those tend to drive up and down with the health of the economy. There's other types of investments which have fundamentally different drivers. Like in the medical industry, people need care in good times and bad times. And it just happens to be that legal is another one. In fact, if you look at the steady growth of the legal industry, it's just up and to the right. And you see that real estate, and same thing with medical, up and to the right. Real estate, gold, interest rates, S&P, all went for a wild ride, cyclic rides. Whereas some of those industries where attorneys are just busy, they're busy in good times and in bad times, people are litigious are really busy. And so same thing with CPA firms and plumbers
Right.
and HVAC. They just fundamentally aren't driven on the same market cycles. And when you invest in lots of different kinds of these, you build what is true resilience, right? It's security because when one goes up and down, it's not all in that basket, right?
Right.
The net of your portfolio shows allocations into what we call non-correlation, non-correlated assets. And so that's what we teach about on our platform. And that's what we offer as sponsors, opportunities to access some of these lesser known novel asset classes and equities in real estate and debt in real estate and medical and in the legal industry where you can get non-correlated returns.
And what does that mean when you say medical? What is that?
So in any industry, there's a lot of ways to invest and you got to solve a need. And so saying like real estate, what does that mean? There's a million ways you can invest in real estate. Medical, there's a million ways you can invest in medical. And not a million, maybe 500,000 ways you can invest in legal. Maybe it's much simple. It's the most simple industry I've ever worked in, the legal industry. But when I say medical, you've got to solve a need. So when you find an industry you really want to invest in, you got to figure out what do they need? How can you invest for a return? And it happens to be that just like real estate operators on our debt side, where we're lending to commercial real estate operators that want to acquire properties or improve them, in medical, there are providers that are doing care and they have to provide that care right away. Why? Because those individuals, they take the insurance that the provider accepts. But what happens? There's a gap. There's a funding gap. For some cases, they don't get paid by that underlying payer, which is a very large insurance or government agency. Sometimes it's 60 days. Sometimes it's 90 or 180 days. Sometimes it's 2 years. And
Right.
sometimes it's 3 years. And so these providers, there's a big funding gap. And that cash flow can be a bottleneck for them. It can delay their ability to live out seasonality. It can delay their ability to invest in more people, equipment, facilities, throttles their growth. And so you can solve a need by saying, hey, look, you've got a large amount of receivables coming to you, and we can underwrite every single one of them. Are they real? Do they have insurance? Was it valid? And is it a part of their contract? And is that a solvent payer? Like basically they all are. They're not like Blue Cross, Blue Shield, whatever. It's like they're basically some of the most solvent payers in America. And so if all those things pan out, you can say, okay, Mr. Provider, you have $1 to $10 million in total receivables. How about we finance a small percentage of those, maybe 10, 20, 30, 40% of those receivables. And then you can realize some cash now. And that cash now you can use for all the aforementioned reasons. And then we'll clip a return on it, just like how a real
It's
estate
based on
operator.
an interest rate? Like,
It varies. Our particular strategy is we'll get a principal back and a finance spread.
interesting.
Yeah. And so just like principal and interest in simple terms in real estate, you have essentially the finance amount, which is your principal amount, and then you have a spread or you have fees and a finance amount right above that. And then we can then redirect the payment to us. And then we can then pay them whatever was on top of our spread. So they still get the upside above
Right.
that. And so that way you solving a need in the space. And the doctors are really excited. It's a boutique industry, not a lot of people doing it, but
So I've never heard of it before. So
every
interesting.
practice struggles with this, right? And it's something that it really helps. And otherwise healthy practices can become healthier because they can finance now and grow, expand, that kind of thing. It's the same thing in the legal industry. It's actually very similar.
Can I ask what a standard return is?
Well,
Like just
like
standard. I know it varies, I am sure, vastly. But what do you, if somebody invests so and they can expect a return of so and
so in every industry, it's like saying, what are
I'm
your
not going to hold
returns?
you to
What
it,
are your
but
standard returns in real estate, right? There's 1,000 ways to invest in real estate. There's 1,000 ways to invest in legal, 1,000 ways to invest in medical. Our specific strategy, where we're looking at existing contracted payer amount, like existing contracts, receivables that have been services been provided and it's been billed, and you can underwrite all of that and the payer, then it's a receivable at that point. You're just waiting for that to come in. It's fairly low risk. There are some that are short term and there are some that are long term, and so you finance a little more. Ours is a diversified medical fund, which is a low receivables of some that are going to come in 30 and 60, and some that we're targeting come to 1 or 2 years, and that gives us a cash flow and growth. But they can be quite large. There are some receivables, like there's an MRI center we're looking at right now where we're gonna clip 12%, and on average they come in about 90 days, and you could
right.
recirculate. So even at 120 days, you could recircle that capital 3 times in a year. That's north of 30% clip. So it's actually pretty, but that helps then the practice use those funds to get ahead of the payments, to buy another piece of machinery and grow their practice, that kind of thing. And just like in real estate, how you have a lien, right? And you have
Right.
financing agreements with guarantees. We have a lien on the practice, financing agreements, guarantees, just like in legal. We have a lien on the attorneys with their agreements and financing, and we get a first position on their returns. So it's all very similar finance structures, but just different industries, ones that are independent of each other.
So cool. And tell me a little bit about your book. What is the best-selling book on Amazon that you authored?
So it's three, but I contribute. I don't write whole books by myself. I
Okay, okay.
work with others and I contribute. And so I've read one of them, the most recent one's called Lessons from Thought Leaders. And I just had such a good time. And I was invited to join this. But there's some really cool dudes on here. There's like Phil Collins, the lead guitarist of Def Leppard. Brian Tracy did the foreword. There's a Navy SEAL here right next to me, which I mean, he's cooler than I am. I'm the only engineering geek on here because there's like Dennis Waitley, Tom Ziegler, Kevin Eastman, and some athletes and coaches and stuff. It was just such a cool book to do. And I tell my whole story, like how I started out as an engineer, and I got into my first pre-development, and I lost everything during the subprime mortgage collapse. And I got an MBA and a master's in engineering, got back up again on my feet, and then learned how to do single family, lost my time. I literally was just busy all the time. And then I learned how to partner and do larger apartments, and did some energy and did some legal, did some medical, started really building portfolio to last, and was able to step away from the engineering stuff altogether. And now my wife and I live in Honolulu, and we get to do this full time, and it's pretty great. But I hope I offer a free copy. If you go to passiveinvestingmastery.com/book,
Nice.
passiveinvestingmastery.com/book. Put the name of the podcast or put Natalie's name in there, because we don't give it to people that randomly just show up. But you can download a copy, or we send you a signed copy. If you go to that secret
Nice.
link and put in the secret code, happy to contribute to your journey if I hopefully helps inspire some other people along theirs.
So sweet. Thank you. And do you have clients under you that give you money in hopes to invest as well? Is that something you do, like a portfolio type of thing, or no?
Yeah, so we have, I mean, on our website at the top, we have our, I think, 4 funds now, there's commercial real estate, debt, steady eddy cash flow, commercial real estate equity, which right now we're taking advantage of the upside of this downturn and getting some really exciting growth. There's litigation finance on the legal side. I mean, helping attorneys represent those that otherwise couldn't afford it. We've got thousands of military civilians and their survivors, sexual assault victims, trafficking, roundup, got all kinds of people that we're supporting the attorneys, and we're financing the attorneys to represent and producing great returns. And then on the medical side, we're financing practices. And so those are all different funds where people can participate as a syndication, as a limited partner, and and join in those returns.
That's amazing. Well, thank you so much. Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info, and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.